Hello, everyone. Welcome to Demand Supply Trading Practical Session number 16 for the year 2025. Myself, Srijit Kakkar, and today is Sunday, 20th of April, 2025. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you regarding the schedule of these sessions. Plus, if we have any promotions coming up, or if we have any upcoming videos related to demand and supply, that is where we keep updating you. So in case you're still not part of this channel and you wish to join the channel, what you can do is you can scan the QR code, which is on your screen. There are a few other ways as well. One, you can go into the description, and in the description, you'll be able to find the direct link. You can click on that link and join this Telegram channel. Plus, once you visit our website, which is surjitkakkar.com, or you can use the short URL, which is sk.coach. So once you're on our website, on any of the pages, you can just scroll down, and at the footer, you'll be able to find this option which says join the Telegram channel, and you have the join now button. So that is also another way how you can join this Telegram channel. Now, today's session is dedicated to practical application of demand supply methodology. Our demand supply course, which used to be a paid course, is now available 100% free. Now, how can you access that course? We'll talk about it as we move forward. But once you go through the course, you basically learn the methodology theoretically. Now, once you have learned it theoretically, what happens is to implement it. If you see some practical examples, it becomes much more easier to understand how it has to be applied, and that is what we do in these sessions. So every weekend I do a practical session where we apply whatever we learned in demand supply course to some practical examples, so that we can see how the methodology has to be implemented. Now, the best part about these sessions is that the examples that I share with you are not examples which have already played out and we are simply reviewing it, because that's a piece of cake. Anyone can pick any chart, apply any indicator, oscillator, and find a number of reasons why they could have been a buyer or a seller. But the real challenge or the real beauty is when you're doing the analysis in advance, and that is what we do in these sessions. We analyze our areas of demand and supply in advance, and that is also what demand supply is all about, that you can pre-plan the areas where you would like to be buyers or sellers when the prices they revisit those areas of demand and supply. So that helps you see how to plan trades in advance, and once these trades they get triggered, we also review them, so you're able to see both the before as well as the after, and that helps you build confidence in the methodology, and that is how these sessions are designed. So to be very comfortable with these sessions, there are some prerequisites, and if you people complete those prerequisites, you will feel much more comfortable with these sessions. And let's say even if you have gone through all these prerequisites, I do understand that initially learning anything can be a little bit overwhelming. So not to worry, as you go through more number of sessions, as you start looking at more examples, you'll start getting very comfortable with the methodology. Now, what are those prerequisites? The very first one is our Trading Essentials course. Now, if you are starting as a fresher, this is not optional for you, but someone who already has a very good trading experience, I would say they can still skip it if they wish to. However, I would still recommend you to go through the Trading Essentials course as well. Now, how can you access the Trading Essentials course? Very simple. Once you're on our website, on the top, you'll be able to find this tab which says Services, under which you'll be able to find Courses. Click on Courses, and the very first one you can see is Trading Essentials. Click on this, and then you have the option to take the course in any of the two languages, which is English or Hindi. So whatever you're comfortable with, just click on that, and you will be redirected to the playlist of the course content. It is laid out for you in a very systematic way: lesson 1, lesson 2, lesson 3. So just go through all the lessons, and that basically covers your Trading Essentials course. Now, I would definitely like to add, you don't have to do any sign-ups or subscriptions to access the course content. Just click on this button and you have immediate access to the course content. So that's your very first prerequisite, which is Trading Essentials course. Now, once you're done with the Trading Essentials course, the next step is to move on to our demand supply trading course, because that is where you will be learning what is demand and supply, how it has to be implemented, and how to access this course. Again, the process is exactly the same. Under Services, you'll be able to find Courses, and now you can see the second option is Demand Supply Trading. Click on it. Just like Trading Essentials, this is also available in both the languages, English as well as in Hindi. So whatever language you're comfortable with, you can take the course in that particular language. And this covers the course theoretically, right? So theoretically, you learn what is demand and supply, how it has to be applied, everything, all the nuances of demand supply methodology. Now, if you want to look at some practical examples, right, how the methodology has to be applied, then you can click on practical sessions. And again, the practical sessions are also available in both languages, English as well as in Hindi. So this will take you to the playlist of the recordings of the previous session, right? All the previous practical sessions that I've taken, you can watch the recordings of that. Currently, I'll say the archive will be close to about 1.5 years of recording. So a lot of content is available to you. So that's your second prerequisite, which is your trading essentials course. Now, during these live sessions, you will see that I use two documents, the rule book and the flowchart, to plan trades very mechanically and rule based. Now, how can you access these documents? Again, very simple. Under services, you'll be able to find downloads. And here you can see the very first one is the rule book. The second one is the flowchart. So just simply click on downloads and you'll be able to download these files. So this is your rule book. And this is your trading, this is your flowchart. So what we'll do is during these practical sessions, you'll be learning how to use these documents to plan trades very mechanically and rule based. Now, before we start with our example for today, we do have one example from the past which was getting carried forward. So it was on the week when Nifty crashed almost 1100 points, right? We opened with a gap down of 1100 points. We did review with the last session, but we did not have an exit on that as of now. So let's see what happened with that particular setup. So just give me a second. Let me bring that up for us. Just bear with me for a few seconds. All right, perfect. So this was the example. This was session number 10, and we did the analysis for this particular zone. And you can see when on the 7th of April, the Nifty gap down around 1100 points, which was close to about 5%. We just gapped down deep into this area of demand. And the last time we talked about, I guess when we did the analysis, the last time it was Friday, right? So it was something like this. So last time when we did the analysis, we talked about we have already moved around 2:1 if we are talking about the original entry price. But since you could have got a deeper entry on this, by now you would be somewhere around maybe 3:1. And if you talk about your target, we were seeing a target which was about 5:1 because of that deeper entry. So yes, we did have the opportunity to make the trade as a break-even trade with this as our target. And you can see what happened the very next day, which was, the very next week, which was on Tuesday. We hit our target and we got about 1:1, 2:1, 3:1, almost 4:1. Based on the original entry price, but since we gapped a little deeper into the zone, we could have easily got a close to 5:1 on this. So now we will be closing this as a 5:1 exit. Anyhow, you can see you have now formation of a new demand area. So if you didn't want to book 100% profits, you wanted to book, let's say, partial profits, and you wanted to trail on to the balance. So the balance could be trailed with our stop loss below the distal line of this demand area. So that takes care of the only trade which was triggered and was pending for us for the review, and it was also open. So now whatever was triggered and open has been reviewed. We can start with our example for today. So just give me a second. Let me bring up today's example. All right. So let's start with today's example. Perfect. So first thing, whenever we talk about trading, I always say trading has to be very mechanical and rule-based. Now, why it should be mechanical and rule-based? I have explained this in a video, and the title of that video is How to Start Trading. You will be able to find the link in the description. In case you have not yet watched that video, do ensure you watch it. Very, very important. Whatever process I've explained in that video, everyone will have to go through that process. The sooner you start, the better it is going to be for you. So since we need to be mechanical and rule-based, what we need to do is we need to create something which is called as a trade plan. Now, when you're learning a new methodology or you've just started learning trading, it's not very easy to create a trade plan for yourself from the very first day. And that is where these two documents, they help you. So I have created a trade plan for you. And again, this is a very conservative approach. With time, with experience, if you want to make some modifications to it, the modifications can be done. But at least you do have a starting point where you can start planning trades in a very rule-based way. So what is my step number one whenever we start planning our trades? Step number one is I need to define my trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies my expected duration of the trade, which is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why am I starting with the trade purpose as my very first step? And the reason is, when we do our analysis, the charts that we use, they are time-based charts, and we have n number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these n number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again go with a very logical approach, and that logical approach is that the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, by definition, I said daily income is a trade which can last for a day or few days. But one thing you need to remember is that when you're trading markets which are not 24-hour markets, like in these sessions, I take examples from the NSE India market, which is not a 24-hour market. And if you're trading markets which are not 24 hours, I'm pretty sure all of you would have experienced whenever the market opens, some of the symbols will gap up and some of the symbols will gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight, by holding a position overnight, we are taking that add-on gap risk, which cannot be avoided. So this is why my recommendation to all of you is that initially our hourlies and dailies should be done strictly as intraday trades, because we don't want to take that unnecessary overnight gap risk. Now, when it comes to weeklies and monthlies, anyhow, we are not expecting that we'll be getting the exit the same day. So here we have no choice. We'll have to keep these positions as overnight positions. But that does not mean that for weekly, monthlies, we cannot have gap against us. It can still happen. But what happens is, because you're leaning against some bigger time frames, the probability definitely reduces, but it can still happen. But as you have more and more experience, you start building up confidence in your analysis. If you want to include daily incomes into overnight trades, that can definitely be done. But initially, we would avoid that as a risk management rule. So step 1 is I need to define my trade purpose. Let's assume I opted, I want to plan monthly income trades. Now, once I've selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So just give me a second. So if I go to page number 28, on the rule book, we start with the topic, which is multiple time frame analysis, because demand supply is not based on single time frame. In demand supply methodology, we use multiple time frame analysis. So what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for the entries and the exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries, like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where the refining time frame can help us. Next, what are the 4 different purposes of trades? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my time frames? And we get the answer from this table. Like in this example, I opted, I want to plan monthly income trades. So now I know as a monthly income trader, my time frames will be monthly, weekly, daily 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate, used for trend analysis. Lower time frame will be daily. That is where we get our ACTS from. ACTS stands for stop loss entry, target, and size. And in case we need to use the refining time frame, then my refining time frame will be the 60-minute chart, which can be used for multiple purposes like fine-tuning the zone, type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Now, mind it, this table, which is on page number 31, is specifically for the NSE market, because this market is only open for about 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, like your commodities, forex, let's say international markets, then you can refer to the table which is on page number 32. But since I'm taking examples from NSE, I'll be following this particular table. So now, as soon as I opted my purpose of trade, I know my time frames will be monthly, weekly, daily, and 60. And I also understand what is the purpose of each and every time frame. So my challenge number one is taken care. Now, the next challenge is, yes, I do know my time frames, but if I talk about NSE as an example, on NSE, we have over 2000 plus companies listed. So humanly not possible that every day I sit and analyze 2000 companies. So what I need to do now is I need to have a process in place which can help me get a smaller list out of these 2000 companies, so that when I have to do my homework, I have to do my analysis, I have to look at a smaller list. Now, the way you can do that is by using certain computer programs which are called as scanners or screeners. So what we do with these scanner screeners is we input certain conditions, that these are the conditions I'm looking for. And then the scanner screeners identifies which symbols are matching with those conditions, and they are shortlisted for us. Now, if you do a Google search, you'll be able to find n number of scanners, n number of screeners, which are based on conventional technical analysis or fundamental analysis. But challenge was there were no scanner screeners which were based on demand supply methodology. So that is where we have two custom built tools. One is called as the demand supply zone alerts, and the other one is the demand supply zone screener, which are purely based on demand supply zones. And if you want to understand how they work, you can visit the product pages. The walkthrough videos are available there. I'll just quickly show you how you can even reach those pages. So very simple. On the services, you have trading view indicators. And here you can see you have alerts, you have screeners, you can click on them, you can visit our product pages where you can watch the walkthrough videos. That will help you understand how these scanner screeners, they basically work. But always remember, irrespective what scanner or screener you're using, whatever results you get from these scanner screeners, you can never blindly buy or sell based on the results, because scanner screeners, they don't tell you what you need to buy or sell. They only help you identify something which is matching with your criteria to get a smaller list. The process can be as simple as I just want to analyze my Nifty 50 stocks every day, or maybe I have my own favorite list of symbols which I want to analyze every day. So choice is yours. How you want to get that small list. Yes, a lot of tools are available. Whichever tool you feel is the best fit for you, use that tool, get your list. Once you have that list, you'll have to analyze them one by one and see which one matches with your trade plan. The one which matches with your trade plan can be an opportunity for you. The one which doesn't match with your trade plan, you simply skip it. So let's assume whatever I applied now, just to just to keep you guys updated, because this is a very common question that I get, that when I'm sharing my examples, how do I shortlist those examples? I do it purely based on the demand supply zone screener. So let's assume we got a list, and in that list, the very first symbol was ABC. So what we need to do is we need to go to the symbol ABC on the lower time frame. So now the question is, what is my lower time frame? And we had the answer from our step number one, that as a monthly income trader, my time frames were monthly, weekly, daily, and 60. And in this, daily was my lower time frame. So daily is the lower time frame, and what we need to do on the lower time frame is identify zone. And by zone, we mean any of these four structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. So if I go to my charts, in fact, even before I go to the charts, let me add here an exciting news for you people, that the demand supply zone indicator, which we have, is now available as a 100% free 7 days trial. So in case you have still not taken a 7 days trial, how you can take that 7 days trial. So once you come to our website, at the services, you have trading view indicators. Here you can click on zone indicator. And on the left, you can see here you have your 7 days free trial. So click on this, and it will take you to this page where you have to fill in three columns. The first one is your full name, the second one is your email address, and the third one is your TradingView username, because this indicator is only available on TradingView. So you need to have a TradingView account. Now, in case you don't have a TradingView account, you can click here to sign up for a free TradingView account, and then you can provide your TradingView username. In case you already have a TradingView account, you can click here to visit your profile, and from that profile, you can identify whatever your TradingView username is. You can provide here. And then you simply click on this captcha, and then submit this form. And once you have submitted this form within 24 hours, the indicator will get activated for you, and you'll get a notification on TradingView that it has been activated, and then you can try it absolutely free for 7 days. So since everyone will have access to the indicator at least for 7 days while we do the analysis, we'll need purely against the indicator, and based on that we'll do our analysis. So here you can see, as soon as I applied the indicator is telling us that we have a rally-based rally structure here, which it has already identified for us. So let's mark this demand area. So here you have your demand area on the lower time frame. So my step number 3, which was to identify the zone, now has been done by the indicator. Is the zone available? The answer is yes. Now, once you have a zone, does not mean you blindly trade it. The next step is to qualify it. And for qualification, you have a 2-step process. In step 1, we'll qualify it based on certain conditions. And in step 2, we'll qualify it based on the booster scoring. So let's start with our step 1. The first thing we'll check is that the zone we have identified, can it be a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. So that is the reason level on top of level is the very first criteria we look into. Now, how do we verify this? It's a very simple concept. If you have an intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame, again, when your intermediate time frame zone is dividing into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be completely inside the intermediate, which we call as a coinciding level. So if you have a coinciding level, it might be a case of level on top of level. But if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone I have identified, does it coincide with any intermediate time frame zone? And in this case, my intermediate is weekly. And you can see wherever my lower time frame zone is, I don't have any intermediate time frame zone. So it is not a coinciding level, and since it is not a coinciding level, it cannot be a case of level on top of level. So level on top of level not applicable. The zone is not because of a gap, therefore gap rules will also not apply. This is the rally-based rally structure to which we do not apply pivot nor authenticity. Pivot nor authentic is only applicable to a drop-based rally or a rally-based drop. Unstable equilibrium is not applicable because the leg out is not going below the basing. So none of these rules are getting applied. Now, if these rules are not getting applied, they cannot disqualify the zone, because to disqualify, first they need to be applicable, and then there can be two possibilities, either qualified or disqualified. So if the rules are not getting applied, by default, is the zone qualified for us? The answer is yes. So now that we know we have a qualified zone, we'll move on to the next step, which is where we'll be applying the boosters. So just give me a second. I'll have to bring up the booster sheet, which I forgot to open initially. All right, so just give me a second. All right, so seems like Okay, so now I have a challenge, and that challenge is that accidentally I made some changes to the booster sheet. All right, so we'll still use the booster sheet, but when it comes to the trade type, it will not do it automatically because, accidentally I typed in 3. So whatever the formula was here, it has been removed. So what I'll do is I'll delete it for now, and I'll manually tell you what kind of trade setup this would be. All right, so starting with the boosters, the very first one is freshness. So let's get back to freshness. If you talk about the freshness of the zone is definitely fresh, gets a score of 3. Talking about strength, we have an explosive move. That is the reason indicator is marking it. Otherwise, the indicator would have not marked this zone for us. Time at the zone, we only have 1 candle in the basing, which again gets a score of 2. And reward to risk ratio will be taking as an assumption. So if you talk about the quality factor, we have a score of 10 out of 10, which makes it as a high quality zone. Now, talking about the probability, we'll start with the location. If I move on to the monthly time frame, you can see on the monthly, this is where we have our demand area. This is where we have our supply area. So you can see we just hit the monthly demand zone, and that is where we started moving up from. And if you talk about the location of the zone, we are located low on the curve, right? So our location is a good location, gets a score of 1. Talking about the trend, if I go to the intermediate time frame, the indicator will automatically do the zone violation analysis for us, and it is telling us we have a violation of 1 demand area and 1 supply area, which makes it as a sideways trend, right? So therefore, for the trend, we'll give it a score of 0.5. Moving to the move from the zone, currently we don't have a 4:1 move, but yes, you never know. It might happen eventually, and then the prices might start coming back into the zone. So currently we'll give it a score of 0, but it might upgrade to a score of 2 if the prices they move up first and then start coming back into our zone. Level on top of level, we have already verified. It's not a case of level on top of level. It is also not a coinciding level. And talking about trap, I'll take a horizontal line here and see, do we have anything which might make the zone work like a trap. So if I a little zoomed out and move somewhere around here, you can see this area in the past has acted like resistance here. It has also acted like resistance here, but I don't see it working like support. So currently I don't have a very clean area which immediately catches my eye and shows me, okay, this has been an area of support and resistance. So unless and until we have that kind of a scenario, I'll give it a score of 0. So if you look at the overall scoring, we have a score of 10, which is a high quality setup, definitely with the assumption of the reward to risk ratio, and 1.5 out of 8 for probability, which makes it as a low probability setup. So it is a high quality but a low probability setup as of now, and a high quality low probability setup should only be traded as a type 2 or a type 3 trade, right? So based on the booster scoring, now we know this is going to be a type 2 type 3 trade for us. Now no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So the next step is to do your proper position size calculation, so that in case the trade doesn't go in your favor, it goes against you, you do not lose more than what your trade plan allows you to lose. So that is where your position size calculation will come into play. Next, whenever the prices are back, we'll have to re-verify, because the markets are not static, markets are dynamic, conditions are changing almost every other second. So before we place our order, we need to ensure that it still qualifies based on my trade plan. If the answer is yes, it qualifies, we'll place our order, in this case a type 2 or a type 3 trade. And once your order has been executed, the last step will be your trade management, where step 1 is 1:1 will make it as a break-even trade, and after that, if you get the opportunity to trail onto it, we'll start using our trading stop loss, and that is how we plan trades in a very mechanical and rule-based way. And that takes care of today's example. Now, before we move ahead, let me add, if these sessions are helping you with your trades, do like the video. If you're still not subscribed to my channel, do subscribe so that you get notified whenever these sessions are happening. And yes, at the end of the session, I definitely take your questions, queries. So if you have any queries related to demand and supply methodology, you can start putting it into the chat box. I'll definitely answer them. But I would also like to add that a feedback which I have got from you people is that at times you might not be comfortable asking your questions, publicly, or here you can just ask your questions. Maybe you have done some analysis, you want me to review it. So we do have an option for it, which is now called as a one-to-one session. So if you want to schedule a one-to-one session on our website, at the top you will be able to find this one-to-one button, and you can schedule an appointment. Now there are two kind of appointment options available. One is voice call. So if you feel that on a voice call you'll be able to ask your questions, queries, and that can help you, then you can go for a voice call. If you feel that yes, you want to share your screen, show your analysis, then you can also go for an online meeting. So that option is definitely there. But again, I'll add that is only for someone who feels that they're not comfortable, let's say maybe putting your questions in a public setup, right? So like we are doing this YouTube live session. If you're comfortable with sharing your questions, queries publicly, you don't even have to go for the one-to-one session. But yes, it is definitely available for those of you who are inclined towards it. All right, so let's see what do we have in the chat box, and we'll quickly look into those questions, queries, and then we'll be ending the session. So why your zones draw only 3 basing candles on that example? All right, so let's go back. Now, I'm not sure which one you were talking about. Maybe you were talking about the one which we were reviewing. So let me go back. All right, perfect. I understand now why you're asking this. Great. So again, those of you who are planning trades are currently based on boring, exciting technique, right? So that is what we talk about when we initially start learning how to identify zones. But demand supply is not based on boring, exciting technique. It is based on price action. Now, if you look at here, even though this is a boring candle, the size of this candle is pretty big. uh, which does not show us a period of equilibrium, right? It shows us that yes, we definitely moved up and then we started basing and then we started moving up. That is the reason, this indicator is not based on boring exciting technique. It's a very advanced indicator. It is based on purely price action. What is price action showing us? And again, if you think about it, someone who is doing this based on, let's say, boring exciting candle, you might say, okay, it's a drop based rally kind of a structure, but the indicator is taking it as a rally based rally. I can also show you this, why it is taking as a rally based rally. And let me do this. If I say display pattern name, you will see it's calling it as a rally based rally, because if you think about this candle is a bullish candle. So that is why it is a rally based rally. But we have given this option in the indicator that if you want the leg-in method to be based on the candle type. So currently it is on the candle type. It's a bullish candle. That's why it is calling it as a rally based rally. If I say I want this to be done based on the candle color, then it will change it to a drop based rally, and the distal line will also move here. You will see. Can you see it has moved a little lower? If I change it back, you can see it will again move a little higher. So that's the beauty of the indicator. We have given you both the options. By default, it does not identify based on the color of the candle. It identifies based on price action, and price action is showing us we moved up, we paused and started moving up. Plus, based on price action, this is not a basing candle. This is a rally. So that is why it is a rally-based rally structure. Can you give the example of refining time frame to check the leg out for the current example? See, again, it has nothing to do with the refining time frame. We do not identify zones based on the refining time frame. That is where we go if we want to apply some additional rules. But yes, I can still go to the refining time frame just in case you want to see how this basically looks like. So if I just go to the refining time frame, you can see, we moved up, and that is where, you had these 2-3 days of basing, and then we started moving up. But yes, if you further wanted to refine your zone, can you see this is where we had another zone, and that is where we touched and started moving up. So the setup would have also been refined even deeper with your entry point a little deeper into the zone. But yes, again, just to help you understand, the indicator is not based on boring exciting technique. It is purely based on the understanding of price action, and the price action here tells us that we moved up. That is the reason this is your rally, this is your basing, and that's your rally, which makes it as a rally based rally structure. So I hope that clarifies the confusion here. And that also brings us to the end of today's session. Thank you so much for joining in. I'll be seeing you now the next weekend. Till then, trade safe. Enjoy your Sunday. Take care. Bye-bye.